The Bretton Woods Agreement, signed in 1944, was a major turning point in the world of international finance and economics. This agreement marked the beginning of a new international monetary system and established the International Monetary Fund, IMF, and the International Bank for Reconstruction and Development, IBRD, now known as the World Bank. The Bretton Woods Agreement was created in an effort to regulate the world's monetary system and prevent another Great Depression. At the heart of the Bretton Woods Agreement was the idea of fixed exchange rates, where each country's currency was pegged to the US dollar, which in turn was backed by gold. This meant that the value of a country's currency was directly linked to the value of the US dollar, which was pegged to gold at a rate of $35 per ounce. This system of fixed exchange rates provided a stable foundation for international trade and investment, and helped to prevent wild fluctuations in currency values. However, by the late 1960s, the Bretton Woods system was facing increasing pressure. The growing costs of the Vietnam War and the Great Society programs led to inflation in the United States, which weakened the value of the US dollar. At the same time, the increasing demand for gold was putting pressure on the US government to maintain the $35 per ounce peg, which was becoming increasingly difficult to maintain. Finally, in August 1971, President Richard Nixon made the decision to move the United States out of the gold standard. This move effectively ended the Bretton Woods Agreement and marked the beginning of a new era in international finance. The US dollar was no longer pegged to gold, and the value of the dollar was allowed to float freely in the foreign exchange markets. This move out of the gold standard had far-reaching implications for the global economy. For one thing, it allowed countries to pursue monetary policies that were more appropriate for their own economic conditions. No longer tied to the value of the US dollar, countries could adjust their monetary policies as needed to combat inflation, encourage growth, or address other economic challenges. Another key effect of the move out of the gold standard was the increased volatility in currency values. With the US dollar no longer pegged to gold, its value was now subject to the whims of the foreign exchange markets. This led to greater fluctuations in currency values, which in turn created new risks for international trade and investment. However, despite these risks, the move out of the gold standard also had some positive effects. For example, it allowed for greater flexibility in the world's monetary system, which helped to accommodate changing economic conditions and facilitate international trade and investment. Additionally, it paved the way for the development of new financial instruments, such as currency futures and options, which provided businesses and investors with new tools to manage their currency risk. The Bretton Woods Agreement established a fixed exchange rate system where each country's currency was pegged to the US dollar, which in turn was backed by gold. This meant that the value of a country's currency was directly linked to the value of the US dollar, which was pegged to gold at a rate of $35 per ounce. At the time, this system of fixed exchange rates provided a stable foundation for international trade and investment by limiting the fluctuations in currency values. However, it is worth noting that the value of gold has changed significantly since the Bretton Woods Agreement was signed in 1944. Today, the price of gold per ounce is significantly higher than the $35 peg established under the Bretton Woods system. In fact, as of 2023, the price of gold per ounce has risen to over $1,800, reflecting the increased demand for gold and changes in the global economy. The increased price of gold per ounce compared to the $35 peg established under the Bretton Woods system reflects not only the increased demand for gold, but also broader changes in the global economy. One of the key factors contributing to the rise in the price of gold is the increasing amount of money that has been printed by central banks around the world. This expansion of the money supply has led to concerns about inflation and the erosion of the purchasing power of currency, which has driven up demand for gold as a safe haven asset. Additionally, the global economic landscape has shifted in significant ways since the Bretton Woods Agreement was signed in 1944. The rise of emerging economies and increased globalization has led to a more interconnected and interdependent world economy, and this has had an impact on the demand for gold and other precious metals. As economies continue to grow and the global demand for gold increases, it is likely that the price of gold will continue to rise in the coming years. It is also worth noting that the move away from the gold standard and the shift towards floating exchange rates has contributed to the increase in the price of gold. Without the constraints of a fixed exchange rate system, central banks are free to pursue monetary policies that may be more inflationary, such as printing more money to stimulate economic growth. This has led to concerns about the stability of the world's monetary system and has increased demand for gold as a hedge against inflation. The rise in the price of gold per ounce compared to the $35 peg established under the Bretton Woods system reflects a number of factors, including increased demand for gold as a safe haven asset, changes in the global economy, and the move away from the gold standard and towards floating exchange rates. As the world continues to evolve and new economic challenges arise, it will be interesting to see how the demand for gold and other precious metals evolves, and how this will impact the price of gold in the future. The shift away from the gold standard and the move towards floating exchange rates has raised concerns about the stability of the world's monetary system. With central banks free to pursue monetary policies that may be more inflationary, such as printing more money to stimulate economic growth, there are fears that the purchasing power of currency may be eroded over time. This uncertainty has resulted in a growing demand for gold as a hedge against inflation. Gold has long been viewed as a safe haven asset, and its unique properties as a metal including its scarcity and durability make it a desirable store of value during periods of economic uncertainty. By holding gold, investors can protect their wealth from the risks of inflation and currency devaluation. Furthermore, the trend towards monetary easing by central banks around the world has added to concerns about the stability of the world's monetary system. With many countries pursuing policies that involve printing large amounts of money, there is a risk that this could lead to higher levels of inflation and a further erosion of the value of currency. As a result, many investors are turning to gold as a way to protect their wealth and ensure its stability over the long term. In short, the move away from the gold standard and towards floating exchange rates has heightened concerns about the stability of the world's monetary system, and this has increased demand for gold as a hedge against inflation. By investing in gold, individuals and institutions can protect their wealth from the risks of inflation and currency devaluation, and ensure its stability for the future. The move out of the gold standard in 1971 effectively ended the Bretton Woods Agreement and the system of fixed exchange rates that it established. Since then, the value of a country's currency has no longer been tied directly to the value of gold, but instead has been allowed to float freely in the foreign exchange markets. This has led to increased volatility in currency values and greater fluctuations in exchange rates. The Bretton Woods Agreement and the 1971 move out of the gold standard were two of the most important events in the history of international finance. The Bretton Woods Agreement established the foundations of a new monetary system that provided stability and predictability in the world of international trade and investment. Meanwhile, the move out of the gold standard marked a turning point in the world of finance, providing greater flexibility and paving the way for new financial instruments and practices. Despite the challenges and risks that this change created, it also opened up new opportunities for growth and innovation in the world of finance and economics. This is for educational purposes only and should not be taken as financial advice. The information provided is not intended to be a substitute for professional financial advice. Please consult a financial professional before making any financial decisions. Please, comment, like and subscribe.